Hello everyone, and hope you guys are doing well and studies going in full swing. Today's video is on an important topic for CA Inter students, that is Accounting Standard 20 on EPS. This is one of the challenging standards where students do face some difficulty. So what about EPS? Now, as per AS 20, EPS, that is earnings per share, is to be presented on the face of the income statement, and there are two types of EPS numbers. There is something called as basic EPS, which is based on actual number of shares that the company has, and then there is something called as diluted EPS, which is based on the actual shares along with certain potential equity shares which have the potential to become equity shares. Now, how do you calculate EPS? Like in your FM as well, you will have various sums where EPS is to be calculated. Now, this EPS is typically calculated as net profit divided by the number of shares. Now, that is a simplistic way of doing your EPS working. However, AS20 rightly thinks that this may not be the best way. Why? Because in the numerator you are taking net profit, which is a for the year item, dividing it by the number of shares, which is typically an as on date item, and hence these numbers are not properly comparable. So how do we come out of this problem? Well, AS20 says that while calculating the basic EPS, in the denominator you will take the weighted average number of equity shares, where the time for which the shares are outstanding will be taken as weights. So over here, how will you calculate the weighted average shares? We will try to solve this along with a few numbers, so you get some clarity as well. So a few important sums will also be done. So we will take the number of days or months as a case, maybe for the shares for which the shares are outstanding as a base for the purpose of calculation. Like for example, if the profit for example is 100 rupees and the company has 10 shares outstanding, then 100 divided by 10, that is equal to 10 is the EPS. However, if one share was issued and existing since the start of the year and the remaining 9 shares are issued somewhere at the end of the year, then I cannot say that merely because I have 1 plus 9, that is equal to 10 shares, that those 10 shares were outstanding for the entire year. No. Some of these shares were outstanding for the entire year, and hence the resources, the money would be there with the company for the entire year. However, the remaining 9 shares were issued somewhere at the end of the year, and hence the resources will be there with the company only for, let us say, a few days, and hence we have to consider that as well while calculating our EPS. So when you calculate basic EPS, in the denominator you will take the weighted average number of equity shares, also called as WANES, where you will take the time as weight. Now we will try to do this with numbers, but before that there is also something called as a partly paid up share. Now I might have 10,000 shares as a company which are of rupees 10 each, fully paid. There may be another company which has 10,000 equity shares. However, these are shares of rupees 10 each, only rupees 2 paid. Now, is the capital available with both the companies the same? Well, one can say there are 10,000 shares. However, the first company on these 10,000 shares has received fully the 10 rupees of capital, whereas the other company has received only 2 rupees of capital, and hence the standard says that whenever there is a partly paid up share, you will convert them into an equivalent fully paid up share, which means we will say 10,000 shares which are partly paid of rupees 2 will give you a capital of 20,000. If hypothetically they were to be issued as a fully paid up share, that means that is 20,000 divided by rupees 10, and hence that comes to probably 2,000 equivalent fully paid up shares. So whenever there is a partly paid up shares, you will convert it into an equivalent fully paid up share and then take it into the EPS calculation. Now this is pertaining to the important points to be taken for the denominator, but before you go to more important points, we will also say that what should come in the numerator. So basically in the numerator you will take the profit attributable to equity shareholders. Remember, equity shareholders will get profit after all expenses are paid out. It can be salaries, it can be wages, it can be taxes, both current and deferred. It can be even extraordinary items and even preference dividend. Remember, equity shareholders get money after even preference shares are paid off, and hence you will consider all items. And then what you get in the numerator is a net profit attributable to equity shareholders. This is after all expenses, all taxes, prior period items, extraordinary items, as well as preference dividend. Now, keeping this into consideration, before you go to the other special cases, we will take a special, a few important questions. We have shortlisted around 6-7 questions, which kind of cover all the topics: partly paid shares, right shares, bonus shares, diluted EPS, control number. So we will try to solve that so that you get a better understanding. So let us review question number 1. This is from your study material. Also, if you have done from our books, these are shortlisted questions from that. Otherwise, you can refer the study material, or I will try to share this if possible on the Telegram channel. So over here, when you look at question number 1, this is on 1st January, balance of shares is 1800. On 31st October, new shares are issued, that is 600. Face value and paid up value is given. Calculate weighted average number of shares, let us say assuming a calendar year, that is 31st December year ending. Now when you calculate the weighted average number of shares, you will say these are shares which are fully paid, whereas these are shares which are partly paid, which means one can say 600 equity shares which are partly paid, that is of rupees 5 each, gives you a capital of 600 into 5, that is equal to 3000. If you divide it by rupees 10, that will give you probably around 300 equivalent fully paid up shares. Now these 300 equivalent fully paid up shares would be in existence, let us say from the date these were issued, let us say 31st October. And as a result, if you have to calculate, let us say veins, the veins over here would be 1800 shares. Let us assume the calendar year which are outstanding for the entire 12 months. So 1800 into 12 by 12, you will take the time based weighted average plus equivalent over here 300 shares. But these 300 shares were issued, let us say in October. So November and December, they are outstanding, let us say for 2 months. And as a result, if I were to do this working, just a second, if I were to do this working, it would be 300 into, let us say, 2 by 12, and hence I think 300 divided by 6 and 1800, I think 1850 would be my weighted average number of shares. Here I have studied the concept of time based weighted average and also the fact that partly paid up shares will be converted into equivalent fully paid up shares. Perfect. That is taking care of the first part of this topic. Going further, there is a special case which pertains to bonus shares. Now what happens in case of bonus shares as opposed to shares issued for consideration? So if there is a fresh issue of shares at full value, money will come in the company and that money will be deployed, let us say for some project which will give you a return. But bonus shares, the journal entry typically, if I finally see, is reserves account debit to share capital, which means it is capitalization of reserves. There is no new money coming inside the company, and as a result, irrespective of the date when bonus shares are issued, or in certain case there is a stock split, that is in case of a bonus shares, reserves account debit to share capital. In case of a stock split, you will say share capital of, let's say, rupees 10 each, one share gets converted to share capital of rupees 5 each, 2 shares. So in both of these cases, we are looking at a book entry and there is no actual corresponding flow of money to the company, and hence it is just a book entry. So what will happen is, let us say in the last year, the company made a profit of 1 lakh and it had 10,000 shares, which means the EPS would be 10 rupees. In the current year also, company made a 1 lakh rupees profit. However, in the current year, it also gave a 1:1 bonus and hence it has a 20,000 share. So if I divide this, the EPS comes to 5. Now, if I compare 10 and 5 on the face of it, now, someone who is a talented chartered accountant like you might be able to, when they look through the income statements, figure out that this is due to bonus. But like you read a newspaper, you just read the headlines. So when I'm preparing the report, on the face of the report, it might appear that there's a 10 rupee and a 5 rupee EPS, which might show a slump, a fall of rupees 5. But is that correct? Well, no. But sir, there are more shares, you're still earning the same profit. Okay, but these additional shares did not give you any additional capital, in the sense any additional money, and hence it was just a book entry. And hence the standard says that since bonus shares are merely a book adjustment, they are actually issued now. So we will assume that these bonus shares were in existence from the earliest reported date. So like for example, currently you are preparing the accounts for the year 24-25. You also need to give the comparable for the year 23-24. As a matter of fact, during the year 24-25, you issued bonus shares. So there is 10,000 plus 10,000. But in the year 23-24, there were actually no bonus shares. However, the standard says that you can assume that these bonus shares would be in existence from the earliest reported date, that is from 1st April 23. As a matter of fact, they were not. And hence, if you open the last year's annual report, you will see 1 lakh divided by 10,000, that is equal to 10 rupees. However, when I prepare the current year's annual report and I am giving the previous year comparable column, I will restate saying that okay, the restated EPS for the last year would be 1 lakh divided by 10,000 plus 10,000, that is 20,000. I will assume that the bonus shares were in existence earlier as well, and hence the restated EPS for the last year will also be based on 20 1000 shares and hence rupees 5, and hence it is comparable. So when a reader looks at the financial statements of the current year and he compares with the financial statements of the earlier year, at least the previous year column, the last annual report that is signed and audited, we don't have to change that. But in the current year financials, when I prepare the previous year column, I will restate it. This is called as retrospective restatement. So I will retrospectively restate the bonus shares or share split, because these are shares issued without consideration. I can do this only for shares which are issued without consideration. However, for general shares which are issued for consideration, full consideration, I cannot do that. So for this, I will take another illustration if that is there behind. So let us say we can probably do it now. Okay, so if I look at illustration number 7, there is an adjustment of bonus and a few other adjustments as well. So let us try. Now NAT, a listed company, as on 1st April 11 had the following capital structure. It had 10 lakh equity shares with a face value of rupees 1 each, and it had 10 lakh 8% preference shares having a face value of rupees 10 each, that is 1 crore. So basically these preference shares, 1 crore into 8%, so probably around 8 lakhs will be the preference dividend if applicable. During the year 11-12, the company had a profit after tax of rupees 90 lakhs. Now this is profit after tax. Usually preference dividend is an appropriation and hence is considered after PAT. On 1st January 2012, okay, on 1st January 2012, so this is somewhere during the year, maybe 9 months later, NAT made a bonus issue of 1 equity share for every 2 equity shares outstanding on 31st December 11. Well, there were 10 lakh shares outstanding on 1st April 11, and hence the bonus issue will be for 10 lakhs into 1 by 2, and hence 5 lakh shares. Technically, this bonus issue is coming from 1st January 12. However, the standard says that these are shares without consideration, and hence you will retrospectively restate from the earliest reported date. So in this case, if there is no previous year column, then from 1st April 11. If there is a previous year column, then the first day of the previous year. On 1st January 12, NAT also issued 2 lakh equity shares of rupees 1 each at their full market price of 7.6. Now, these are shares issued for a consideration, and hence they will be included in your veins only from the date these shares were actually in existence. NAT shares were trading at 8.05 on 31st March, that is fine. Further, it has been provided the basic EPS of the year 31st March 11 was previously reported at 62.3. So maybe if your EPS was 62.3, I don't know the PAT of the last year. However, there were 10 lakh shares earlier, equity shares at the start of the year. Assuming there was no changes, maybe your PAT would be 6 crore. No. Yes. If this is 10 lakhs, okay, I'll have to do some working because there may be some preference dividend as well. But this is your 62.3. Let us say it was previously reported. Calculate the basic EPS to be reported for NAT for the year ended 31st March 12, including comparative figure in accordance with AS 20. So if I had to do this working, I would say that it seems that the profit after tax is 90 lakhs, but this 90 lakhs is profit after tax. I will also have to pay some preference dividend, and hence the remaining 82 lakhs is attributable to the equity shareholders. Now I have 10 lakh shares which are outstanding for the entire 12 months. So into 12 by 12, on these 10 lakh shares, I am further issuing a 5 lakh bonus share. Now technically the bonus share is issued on 1st of January. However, we assume that they would be outstanding for the entire year. The date of bonus issue does not matter. So I will do a 12 by 12 weight. And then I will issue another 2 lakh shares at full value. And these are issued on 1st January. So the weight would be 3 by 12. So over here I will probably take 82 lakhs. And to this I will divide, let us say 10 and 5, 15. 2 lakhs into 3 by 12 will probably be 50,000. So 15 lakh, 50,000. And hence if I take 82 divided by 15 lakh 50, it will be approximately 5.29. So if you go to see over here, you will have the EPS for the year 11-12. Where is 11-12? Yes. EPS for the year 11-12, as you can see over here, is 5.29. Now I need to find the comparative EPS for the previous year. So if I want to find the comparative EPS for the previous year, in this case, the EPS is calculated as 62.3. So this is profit 62.3 equals profit attributable to equity shareholders. So let's say this is PAT after preference dividend is X divided by, let us say in the last year there were 10 lakh shares. Therefore, if I go to see X will equal to 62.3 into 10 lakhs, that is 623 lakhs. 623 lakhs is 6 crore 23 lakhs. Now 6 crore 23 lakhs is a profit. In the last year there is no change in profit. However, if I prepare the restated EPS, for restated EPS I would say, let's say the reported EPS in the last year has gone at 62.3. However, now 6 crore 23 lakhs, that is a profit attributable to the equity shareholders, upon 10 lakhs into 12 by 12. However, the bonus shares are also assumed to be in existence from the earliest reported date. So I will retrospectively restate and say that this is existence for the entire year. So this is 6 crore 23 lakhs divided by, for example, 15 lakhs. And as a result, 6 crore 23 divided by 15 will come to 41.53. So when I prepare the EPS for the year 11-12, I will say that the basic EPS is 5.29 that we calculated earlier, and then when I go to the year 11-12, earlier actually the EPS was 62.3. However, the restated EPS is now going to be 41.53 as you can see over here. So this will be an adjustment due to restatement of bonus. Explain why bonus issue and shares of issue at full consideration are treated differently in the calculation of basic EPS. So this is a theory question which says that shares issued without consideration would not come with a corresponding capital infusion, and hence it is just a book entry, and hence to ensure comparability we will ensure that we will adjust it retrospectively. But for a share issue for full consideration, there is actual money flowing in, and hence we will consider this working from the date the actual money is coming in. So that takes care of bonus. Further, we will now go to the fourth and in my opinion the most important part when it comes to the basic EPS calculation, that is right shares. Now in case of right shares, these are shares for consideration but not for a full consideration, because usually right shares are at a discount. So when we look at right shares, there may be some hidden bonus element, because right shares are for consideration but not for a full consideration, and hence how will we quantify that? Now institute gives you 3 steps. It says you will first calculate something called as a theoretical X rights price. What is the theoretical X rights price? You will take the number of shares pre the rights into the price of the shares pre the rights plus the number of new shares under the right issue into the right issue price. So that is your total, let us say, market value of your investments pre the rights plus the right issue proceeds divided by the number of shares pre rights plus the rights issues. So over here we will do it again with numbers, like if I had 4 shares pre the right whose value was 60, rights issue price, let us say for 1 share, let us say the price over here is, let us say 30, that is at a discount. So if I want that 1 share of rupees 30, I need to have 4 existing shares. The rights ratio is, let us say, 1:4. So over here the total investment for 4 plus 1, that is 5 shares, is equal to, let us say 240 and 30, that is 270. 270 divided by 5 comes to 54. So this is the theoretical X rights price, excluding rights price. This you would do even, I think, in your accounts and FM, if I'm not wrong as well, but otherwise it is there in your accounts. Theoretical X rights price. Now ideally the price prior to the rights and price after rights should be the same. However, it is changing, and it is changing because of the rights issue, and hence as a second step you will calculate rights adjustment factor. Now how do you calculate rights adjustment factor? That is 60 divided by 54, and hence this comes to probably 60 by 54 comes to what, 1.11111, or let's say 10 divided by 9. This is a rights adjustment factor, or 1.111. Now technically what does it mean? Usually when you look at a bonus, after bonus, let's say it's a 1:1 bonus, then pre-bonus there was 1 share, post-bonus it becomes 2 shares. In a similar way, what we are trying to say is, in this case, pre-bonus, simplistically, if there were 9 shares, post-bonus there will be 10 shares, so there will be 1 additional share which is like a hidden bonus. You can't see that in a right, but when I took the ratio 10 divided by 9, 1.11111, that 0.11111 is the additional bonus element, and since bonus has to be retrospectively adjusted, you will multiply the rights adjustment factor, that is 1.11111 or 10 by 9, to all the number of shares prior to the date of rights. Remember, from the date of rights, you will include the right shares into the working, and hence you don't need any further adjustment. But you will multiply the rights adjustment factor to all the number of shares prior to the date of rights. Over here, there is also a detailed conceptual understanding on why this is done, but from an exam perspective, just remembering these 3 steps and proceeding, it should kind of work. So you will multiply the RAF to the shares outstanding prior to the rights issue, because once you actually issue right shares, the entire right shares, including the bonus element, everything, the total value will be there in the denominator. You will do the rights adjustment factor to all the share issues which are outstanding prior to the date of rights. Typically, in case of right shares, if basic EPS is to be found, we usually try to find the basic EPS using the cumulative approach. So there are 10,000 shares, for example, for 2 or 3 months, then another 2,000 right shares are issued, so 10,000 into the rights adjustment factor into 2 by 12, and then 2,000 shares, so 12,000 into, let us say, 10 by 12. Again, to just listen to this is a little confusing. You do it with numbers and it will kind of flow through very seamlessly. So if I go to question number 2, over here, in question number 2, you have a rights question. So first question is fully paid shares, question 7 was on bonus shares, question 2 is on right shares. Net profit for the year 16 is 11 lakhs, for the year 17 is 15 lakhs. Number of shares outstanding prior to the rights are 5 lakh shares. Right issue price is 15 rupees. Last date to exercise right is 1st March 2017, and right issue is for 1 new share for each 5 shares outstanding. So basically, if there were 5 lakh shares, and I'm getting 1 new share for each 5 shares outstanding, 5 lakhs into 1 by 5 will give me 1 lakh right shares, new shares. Fair value of 1 share immediately prior to the rights on 1st March was 21 rupees. Compute basic EPS, let us say assuming calendar year. In all of these cases, let us say we are assuming a calendar year case. Now, when is the rights issue made? 1st March 2017, that is in the calendar year 2017. So when you look at the rights issue, the 3 steps that you have to follow is, first calculate the theoretical X right price. I can do that on a totality basis or a per shareholder basis. So if I look at the per shareholder, I will say that if I want to entitle to 1 right share, I need 5 existing shares, but 5 existing shares in the market are worth 21. But if I can arrange 5 shares at 21, I can then get an entitlement to buy 1 share at the rate rupees 15. So for the total of 5 plus 1, that is 6 shares, this is 105 plus 15, that is 120. 120 divided by 6, probably this is coming to 20. After the rights, the price will fall to 20. Like after the bonus, the share price falls. After a fresh issue for full consideration, ideally the share price need not fall, but after the bonus it does fall. In a similar way, if it falls after rights, that is because of the hidden bonus element. That is a concept that the standard tries to imbibe. So this is point 1. Point 2, you will try to find the rights adjustment factor. You will say pre-rights, the value was 21. Post rights, the value is 20. So 21 divided by 20 comes to around 1.05 will be the rights adjustment factor. Now this will be multiplied when we calculate the basic EPS to all the shares that are outstanding prior to the date of rights. And in the year when right shares are issued, you will do a cumulative working for veins. So over here, if I look at bonus will be retrospectively adjusted. So over here, point 3, if I try to find basic EPS, for which year? Well, first, for the current year, that is the year 2017. In the year 2017, I had 15 lakh worth of profit. 15 lakh divided by the number of shares. Now over here, earlier I had 5 lakh shares. But these 5 lakh shares are outstanding for January and February, that is 2 months. But this is prior to the date of rights, so I will have to multiply into 1.05, the rights adjustment factor, into 2 by 12. Cumulative basis. After the right shares are issued, there will be a total of 6 lakh shares. This will include everything, all the 6 lakh shares. If there's a hidden bonus, that is also part of the 1 lakh shares. Into directly 10 by 12, that is the remaining months. And hence, I will take 15 lakhs divided by, I will, let's say 525 into 2 by 12 m plus 6 lakhs into 10 by 12 M plus MRC, and hence this is 587 500. If you divide this is 15 lakhs divided by 587 500, and this is 2.55. So this will be 2.55, which you say is, let us say, the basic EPS for the year 2017. However, you have also been given the data for 2016. Now 2016, actually there were no right shares. So if I go back to the last year's report, I would have done 11 lakhs divided by 5 lakhs. So probably 2.2 must be the reported EPS, reported. However, in the current year, if I have to find a restated EPS, so if I have to find a restated EPS, let us say for the year 2016, so I will say that the profit continues to remain 11 lakhs. Last year there were 5 lakh shares. Now these are shares of the last year. This is prior to the date of right, and hence I will multiply the rights adjustment factor and then a time factor of 12 by 12. So this is nothing but 11 lakhs into 5.25 lakhs. If I divide this 11 divided by 5.25, comes to around 2.095. This will be the restated EPS. So in the current year column, I will show 2.55 as current year's basic EPS, and then I will have 2.095 as the restated EPS of the last year. So I can see, as you see over here, 2.095 and 2.55. Okay, now before we do question 3, there is another question, question 4, which is based on the basic EPS working only. From the following information relating to Y Limited, calculate the EPS. Okay, so profit before VRS payments may be one-off payment, but if it is paid, that is to be considered. But after depreciation, so if I have to do the workings before, let us say, VRS, and after depreciation, when you calculate the profit, it has to be after everything, depreciation, VRS, taxes, everything. Is this profit already after depreciation? Yes. So do I need to subtract depreciation again? No. So this is already after depreciation. Ideally depreciation should have been subtracted, but because it is after depreciation, we will not subtract this depreciation again. However, will I need to subtract the VRS payments? Yes, I will need to subtract the VRS payments. I will also need to subtract tax and fringe benefit tax. So all of these are expenses. 75 minus 32.1 minus 10 minus 5. So I will be left with 27.9, which is attributable to the ordinary shareholders. I will again repeat, some students wrongly believe that we are not deducting depreciation. We are not deducting because it is already deducted. If this was given as before depreciation, then we would have deducted that as well. So 27.9, this is paid up share capital of rupees 10 shares, each fully paid, rupees 10 shares. So I will say divided by 9.3, 93 is a share capital. 27.9 divided by 9.3 comes to probably 3 rupees. This 3 rupees will be your basic EPS. As you can see over here, basic EPS is, let us say, 3 rupees. Question 3, question 5 and question 6 are pertaining to the next concept of this chapter, which is diluted EPS. Now diluted EPS, as the name goes, dilution. What does the word dilution mean? Does it mean an increase? Does it mean a decrease? Dilution means decrease. So diluted EPS over here refers to kind of the worst possible EPS if an entity has potential equity shares, and if these potential equity shares convert, then what will be my EPS position? Now first of all, before we proceed further, we need to understand what are potential equity shares. Potential equity shares are shares or instruments which have the potential to become equity shares, like a convertible debenture, like a convertible preference share, like an option or a warrant. These instruments have the potential to become equity share, and hence if there is a convertible instrument, it has not yet been converted, but it has a potential to be converted, and hence we are trying to build a hypothetical position that if this was indeed converted, then what will be my EPS? But was it actually converted? Well, probably no, and hence what will we have to do? We will have to assume a conversion. So if we say that, okay, if there were convertible preference shares, and if these convertible preference shares had actually converted, but from when would they have converted? Well, I don't know. So the standard over here says you can assume that they were converted from the beginning of the year or the date of their issue, whichever is later. In general, if the preference shares, convertible ones, were outstanding for the entire year, we would have said that, well, they could have been converted on any of those 365 days. However, if they were outstanding institute says that what if they were converted at the start of the year? If they were converted at the start of the year, the equity shares on that conversion will be included for the entire 12 months. If they were converted somewhere during the year, then equity shares will be included from the date they could have been possibly converted. But if the preference shares had actually converted, will I still need to pay them the preference dividend? Answer is no. So I don't need to pay them the preference dividend. So when I calculate the diluted EPS, I'm hypothetically thinking that what if these preference shares had converted at the start of the year? Well, if they had converted, I will not need to pay them any dividend, and hence in the numerator, the profit which was after dividend I will add back. In the denominator, I will add back the number of shares to be issued, and the EPS that I will get will be the diluted EPS in general, provided this EPS has fallen. Diluted EPS means a reduced EPS. Stake dilution means stake reduction. So if EPS falls, it is called as diluted EPS. If it does not fall, these instruments are anti-dilutive. We will do a number based thing over here, but before you do that, some bit of practice. Let us say you have net profit attributable to equity shareholders after preference dividend of 10,000 divided by 1,000 weighted average number of equity shares, and hence your EPS, basic EPS, let us say is rupees 10. Now let us say this company has convertible preference shares. These are 1,000 preference shares of 6% coupon and at the rate face value rupees 100, and these were outstanding for the entire year. Their conversion ratio is 1:1, which means one preference share will convert into one equity share. Now if I want to find a diluted EPS, I will say that okay, this 10,000 was calculated. This 10,000 was calculated probably, just a second. Okay, let me just make it 10, or rather let's say these are 100 preference shares, 100 preference shares of 100 rupees each, and 6% is a coupon. So over here I can say that, well, if the current, I will start where basic stops. So in basic EPS, I will start at 10,000 divided by 1,000 equity shares, but 10,000 is after preference dividend. If you assume that these preference shares had converted, then I don't need to pay them any preference dividend. So 6% of, let us say 10,000, that is the total face value, 6% of 10,000, probably that is 600 rupees, will be your saving. So in the numerator, you will add back 600. So if preference shares were converted, there will be a 600 rupees saving. You will add that in the numerator, but at the same time, 100 preference shares will get converted into 100 equity shares. So there will be another 100 rupees or 100 equity shares issued, and hence 10,600 divided by 1,100 will give you, let's say 10,600 divided by 1,100 will give you 9.64. Now 9.64 is lower than 10, and hence we say that this is diluted. If these preference shares were to hypothetically convert, I want to keep the readers mentally prepared that if they convert, by the way they have not, but if they do convert, then what will be the position? The all else remaining constant, your profit will fall to 9.64. 9.64 is lower than 10, and hence these instruments are dilutive. However, if this was not a 6% preference share, this was a 16% preference share, again, there's still potential equity shares. They have the potential to become equity share. 100 preference shares have the potential to become 100 equity shares, and hence in the denominator, I will still add 100. In the numerator, the 1600 will be added. Why? Because preference dividend will be 16% of 10,000, that is equal to 1600 that you will save. Now what will that result into is, when you do the workings, 11,600 divided by 1100 comes to around 10.55. So in this additional case, I will get my EPS at 10.55. So if the preference shares were to convert, then it is beneficial for the equity shareholders. So prudence and conservatism says, no, let us prepare them for the worst possible situation. That is, if the preferences were to convert and if the EPS were to fall, I will disclose that at diluted EPS. But if the preferences were to convert and the EPS were to rise, I will ignore that conversion and continue to show the diluted EPS at 10 rupees only, not at 10.54. So I hope that is clear. So when we are looking at, let us say, preference shares, this is the working. A similar working is also possible in case there is convertible debentures. Now instead of preference shares, if these were debentures, what would change? Well, remember, preference shares, we pay preference dividend. Preference dividend is after calculation of taxable profit, and hence whether we pay preference dividend or we don't pay preference dividend, there will be no impact on our tax. However, when I look at debentures, debentures have interest, and if interest is saved, that is, if the debentures were converted at the start of the year, and if interest is saved, then if interest is saved, it will also have an impact on tax, and hence in the numerator what I will say is 10,000, to which I will add back. I will say that okay, if the debentures were to convert, I will save 600 rupees of interest, and 600 rupees of interest into 1 minus 0.3. That is a net of tax savings, and as a result I will have, let's say in the numerator, if I were to do the working, this is what, 600 into 0.7, 420 plus 10,000, 10,420 divided by 1100, which comes to 9.47. This is still lower than basic, and hence it is diluted. So basically what we need to remember is, when you're looking at the diluted EPS, you will take the veins as per basic EPS, profit attributable as per basic EPS. To this you will add back preference dividend. If there's any dividend distribution tax, you will also consider that. Now it is abolished, but in case it comes, plus the shares on conversion of preference shares. If it is bonds or debentures, I will take interest into 1 minus t, because the net of tax saving should be considered. Again I will add shares on conversion of these debentures. Now considering this, before we proceed further, I would want to kind of tackle a question number 5, so that your concepts of convertible instruments, diluted EPS, are relatively more clear. While calculating diluted EPS, effect is given to all diluted potential equity shares that were outstanding during the period. Explain the statement in light of the relevant AS. So over here we are trying to say that diluted EPS will give effect to potential equity shares which are dilutive. If they are anti-dilutive, you will not give effect. It's a theory type of a case. Also calculate the diluted EPS from the following information: net profit for the year, after tax, number of shares outstanding, this is 10 lakhs. If I divide it, probably basic EPS comes to 10. Number of 10% fully convertible debentures of rupees 100 each. Remember, to these debentures I must have paid interest, but interest must have already been deducted while calculating net profit. So the profit that you see is after all expenses, and hence interest would have already been deducted. Each debenture is compulsorily and fully convertible into 10 equity shares issued at the middle of the year. Now this is a little tricky. This time the debentures are issued at the middle of the year. So we will say that these debentures have the potential to become equity shares, and hence they are potential equity instruments. However, we usually include these potential equity instruments from the start of the year, assuming they must be existing at the start of the year. But if these debentures itself came into existence in the middle of the year, the earliest they can become equity shares is when they came into existence. So if they came into existence on 1st October, they cannot be converted before 1st October, and hence you need to be a little careful. In such case, you will include the potential equity shares only from the date of issue or the start of the year, whichever is later. Debenture interest expense for the current year is given to you, let us say, as 5 lakhs. So probably that is this is number of debentures of rupees 100 each. So this is 1 lakh debentures into rupees 100 comes to 1 crore. 1 crore into 10% will come to 10 lakh of interest for the entire year, into 6 by 12 will come to probably interest of 5 lakhs. As you can see over here, debenture interest expense for the current year, and assume the applicable income tax rate is 30%. Now if you want to calculate diluted EPS, what will you do? We will start where basic EPS ends. So basic EPS ends at 1 crore in the numerator, it ends at 10 lakhs in the denominator. Remember, 1 crore is after interest because net profit is after interest. But if these debentures were to convert, will I save interest? Yes. How much? 5 lakhs. But 5 lakhs is before tax. There will be a tax impact as well. The tax rate is given to you as 30%. If this was preferentials, I will not do a 1 minus t. If there are debentures, I will do a 1 minus t. In this case, in the denominator, 1 debenture is convertible into 10 equity shares, which means if there are 1 lakh debentures, these 1 lakh debentures will convert into 1 lakh into 10, that is equal to 10 lakh equity shares. But these 10 lakh equity shares, earliest which can come into existence is when the debentures were issued, that is in the middle of the year. And as a result, this will have a 6 by 12 time weight. Had this mid of the year not been given, then obviously the interest would be for the entire year, let us say 10 lakhs, and the instruments can also be converted into equity from the start of the year, in which case I will do the entire 10 lakhs in the denominator. Over here, if I take, let us say 1 crore plus, I think 3 lakh 50, that is 1 crore 3 lakh 50,000. In the denominator, this is 10 lakhs into 6 by 12, that is 5 lakhs, and hence this comes to, let us say, 15 lakhs. So over here, this is 1 crore 3 lakh 50,000 divided by 15 lakhs comes to 6.9. Your basic EPS was 10. Diluted can be less than basic. Well, it is less than basic, and hence this will be treated as diluted. As you can see over here, 6.9 is a diluted EPS. So this kind of hopefully clarifies the concept of diluted EPS for you. The more sums you practice, the better understanding you will derive. Now there is one more area which is a little more trickier as compared to convertible debentures or convertible preference shares, that is options and warrants. Now the problem in case of options is, when options are exercised, usually options come with an exercise price. So let us say an entity has issued 1000 options convertible in the ratio of 1:1. However, when the options are exercised, the holder of the option has to pay 50 rupees to the company, and against that the company will issue shares. Now the problem is, in case of a debenture, when it is converted, the entry is debenture account debit to share capital. When a preference share is converted, the entries preference share capital account debit to equity share capital. Basically, there is no new flow of money on conversion, and hence conversion is kind of a book entry. However, if you assume hypothetically that options were converted or exercised at the start of the year, then yes, I will end up issuing 1000 new shares. But those 1000 new shares will give me 1000 into rupees 50, that is 50,000 rupees of actual money. Now that 50,000 rupees of money does not go to the P&L, it is capital in nature. However, if hypothetically these options had converted at the start of the year, I would have received 50,000 rupees, which I could have used in my business and generated more profit. If debentures were converted at the start of the year, I would not have received any additional money. It will be debenture account debit to share capital, that is it. But if options are converted, I would have received money at the start of the year, which I could have deployed in the business, and I could have earned a profit. Now, how much profit, I don't know. And hence, in order to ensure standardization, AS20 says that we will assume that what will I do with the 50,000 rupees received? I can't just ignore it. I will assume hypothetically that this 50,000 rupees, that is 1000 into rupees 50, will be used. I don't have any end use, so it will be used to buy back entity's own equity shares. But when I go to buy back entity's own equity shares, I'll have to buy back from the market. And from the market, I will have to buy back at the prevailing average market price. So let us say the average market price over here is, let us say, 80 rupees. So I will say that there are 1000 equity shares that I will actually issue if I assume that the options were converted or exercised at the start of the year. But at the same time, against this 1000, I will get 1000 into 50, that is equal to 50,000 rupees, which I will use to buy back my equity shares at the rate of rupees 80, which is the prevailing market price of 50,000 by 80. I will buy back 625 shares. And hence, all said and done, after all of this, I will issue 1000 shares, so my denominator will increase by 1000, and I will buy back 625 shares, so my denominator will reduce by 625, and hence net there are only 375. These are called as incremental or free shares that will be included in the diluted EPS calculation in the denominator. Usually, like you pay dividend for a preference share or you pay interest for a debenture, you don't really pay anything to an option, and hence there is no cost saving in the numerator. However, the option brings you 50,000 rupees, and this 50,000 rupees you will deploy for buying back your own shares. Even after buying back, you are still left with 375 incremental shares, which will be taken in the diluted EPS calculation. Now this is a little tricky, and again we would want to practice this along with the problem. So over here, if you look at question number 3, okay, it's between this 2 and 4 over here. I think 3 was not written. Question number 3. Net profit for the year 2017 is 12 lakh rupees. Weighted average number of equity shares outstanding is 5 lakhs. So 12 lakhs divided by 5 lakhs comes to around 2.4, which is your basic EPS. Average fair value of one equity share during 2017 is 20 rupees. Weighted average number of shares under the option scheme in 2017 is 1 lakh, which means if the options were to be exercised, 1 lakh shares will be issued. But if options were to be exercised, 1 lakh into the exercise price, that is equal to 15 rupees, that is 15 lakhs of capital will flow in the company. I can't really ignore that. Remember, when debentures or preference shares get converted, no real capital flows in the company. It is just a book entry. But when options get exercised, actual capital flows in the company. Compute the basic and the diluted EPS. Basic is computed at 2.4. For diluted, I will take 12 lakhs in the numerator, and in the denominator, I will start with 5 lakhs. I will start where basic ends. To this, a student might blindly say, okay, I will add the entire 1 lakh shares in the denominator. In the numerator, there is no cost saving. There was nothing to be paid to the option, so nothing is added. But that is wrong. I cannot add the entire 1 lakh because I will issue 1 lakh shares, yes, but this will give me 1 lakh into 15, that is 15 lakh rupees, which I will buy back. 15 lakhs divided by 20. I will buy back at 20 rupees in the market, and hence that is equal to 1 lakh minus 75,000. If I do the math, this will be 25,000 incremental shares, considering a 15 lakh inflow and a 15 lakh outflow. And hence this 25,000 will be separately added. So this is 12 lakhs divided by 525 comes to probably 2.29. Now 2.29 is less than 2.4 and hence can validly be called as diluted EPS. So that takes care of question number 3, and by and large that takes care of most of the areas of EPS. Now there is one more special case that can be possible where there are more than one potential equity shares in a single question. Most of the institute's problems have only one equity share in a question, one potential equity share, like only convertible debenture or only convertible preference share or only options. But if they have more than one convertible instrument in a single question, then you can't directly take all of them together and solve, because there may be some potential instruments which may be dilutive, some may be anti-dilutive, and hence a ranking has to be done and a method has to be followed. So what will we do? We will try to calculate the incremental EPS. Incremental EPS is the cost saving, like a preference dividend saved or interest into 1 minus t saved, divided by the number of potential shares that you will have to potentially issue, or the incremental shares in case of options. This will give you the incremental EPS. You will rank them in the ascending order. So the lowest incremental EPS comes first because that security is the most dilutive, and the highest comes at the end. And then you will solve on a step-by-step cumulative basis by including one potential equity share at a time. So you will first, let us say, take options. Then if it is dilutive, take preference shares. Then it is dilutive, take debentures. If it is not dilutive, then, so if the EPS on including debentures increases, we call it as anti-dilutive, and we will stop the working at preference shares. So you will need some practice. Institute usually does not ask you a question on this, but if it does, you should be aware. Okay, presentation and disclosure, we said it should be presented on the face of the profit and loss, both standalone and consolidated. In case there are some extraordinary activities as well, then you will have to show the EPS, basic as well as diluted, before extraordinary activities, then after. This is for extraordinary activities, and then total. So basically you will have to take, if there are some extraordinary events like lottery winnings, then EPS from continuing operations without extraordinary activities, then separately EPS from extraordinary activities, and then the total EPS. Now in this particular case, the problem that can arise is earning per share can be net profit, which is usually positive, divided by variance, but sometimes there can be a net loss. Even if it is net loss divided by variance, it will give you a negative EPS, which is very much possible. Like there can be net profit for all the shareholders, there can also be net loss for all shareholders. So if there's a net profit for a single shareholder, there can also be a net loss for a single shareholder. Now the problem is, let us say your regular operations have a 2 lakh profit, there is a 4 lakh loss due to earthquake in the current year, which is due to, let us say, an extraordinary item. This is ordinary, and hence total, if I go to see, company has a net profit of 2 lakhs. Now let us say the company has gains of 10,000. So if I have to give a separate disclosure for all the three, I would say that for basic EPS, 2 lakhs divided by 10,000, that is 20. This is negative 40, and this is negative 20. So this is fine, but the problem is, what if there were potential equity shares? Let us say potential 2,500 equity shares, maybe incremental shares or whatever. Now the problem is, if I include the 2,500 equity shares potential over here, then this will become 12,500, 12,500 and 12,500. This is for the diluted EPS calculation. This was for basic EPS calculation. So if I include the 2500 potential shares, my EPS from ordinary activities will be 2 lakhs divided by 12,500 will be 16 rupees. So that EPS is falling. Earlier it was 620, now it is falling to 16, so it is dilutive. However, if I take 4 lakh negative divided by 12,500, it comes to a negative 32. This comes to a negative 16. Remember, loss per share, if it falls, earlier the loss per share was 40, now the loss per share is 32, which means this is anti-dilutive. I want to show the worst possible picture. So the problem is, will I include the 2500 additional potential shares or not? If I include them, it dilutes the EPS from ordinary activities, but it is anti-dilutive for extraordinary activities, in which case there is a control number. This can be extraordinary activities, this can be discontinued operations, whatever it is. What is more important, the extraordinary activities, the continuing activities, the discontinued activities? What is more important? We say that the continuing ordinary activities are of most importance. Hence, this 2 lakhs divided by 10,000, that is 20, is taken as a control number. What does it mean? That if the inclusion of this 2,500 reduces the EPS from control number is the EPS from ordinary activities, continuing operations. If it reduces the EPS from these numbers, then I will include this 2,500 everywhere, from extraordinary, from other operations, everywhere. But if it is anti-dilutive, that is, it does not reduce the EPS from these ordinary activities, continuing activities, then I will not include it anywhere. Again, sounds to be a little tricky, and hence we will try to probably present it, understand it using a sum. And once you do that, hopefully your entire AS20 should be clear, and your marks you should be getting after you have watched this entire video. So over here, as we said, if EPS falls, it is dilutive. If it rises, it is anti-dilutive. That is okay. So the last question on this, I think we will touch upon question number 6. X Limited during the year ended 31st March 11 has income from continuing ordinary operations of 2,40,000, a loss from discontinuing operations of 3,60,000, and accordingly a net loss of 2,40,000 minus 3,60,000, that is equal to 1,20,000. That's a net loss. Company has 1,000 equity shares and 200 potential equity shares outstanding as on 31st March 11. Compute the basic and the diluted EPS in this particular case. So if I look at continuing, discontinued and total, if I want the basic EPS, I will directly take, let us say, in lakhs 2.4 positive divided by 1,000 equity shares. So let's say everything is in thousands, 240 divided by 1, that will come to probably 240. Discontinued will be negative 360 divided by 1, that is negative 360. And if I look at total operation, negative 120 divided by 1, that is negative 120. Now there are 200 potential shares. Should I include them or not? Well, I will first try to find the EPS from the continuing ordinary activities if I include them. So this is 2,40,000 positive divided by 1,000 plus 200, that is 1,200, and hence 2,40,000 divided by 1,200 comes to around 200. So on inclusion of this 200 shares, your EPS from continuing operation actually falls, and hence your diluted EPS will be 200 rupees. However, if I were to include this 200 at other places, maybe EPS, the loss per share might fall. But because the control number is falling, I will have to include it everywhere. And as a result, I will take, let us say, 3,60,000, 3,60,000 divided by, let us say, 1,200. This comes to a negative 300. Sir, loss per share is falling. Still, I will take it because the control number is falling. And this is 1,20,000 divided by, let us say, 1,200. This is, let us say, negative 100. And hence, this would be your final position. Negative 120 would be the basic EPS. Diluted would be 100. So this you can see 120 and 100. Are we clear with this? Okay, from continuing it is 240 and 200 and so on. So I guess that should be it. I hope this video has been helpful in your preparations, and in case EPS sum comes, you should be able to crack it pretty well. I will then see you soon with other videos. If you like such content, please do like, share and subscribe with your friends. If you need any specific topic to be covered in such a form or any improvements that you would want to suggest, please do write in the comment box and I will try to incorporate and share it with you to the best extent possible. Okay, so lots of love to you guys, more power for your preparations, good luck, and I'll see you soon with more videos. Bye bye, take care.